Hey guys, what's going on? This is Ron with Liquidity Cartel, and we're back with my next installment here. We're going to talk a little bit about liquidity, about why liquidity sweep matters. I mean, we're called Liquidity Cartel, and we wrote an entire book on it. Spent many years studying it, why it matters. I've done every facet and aspect of trading out there, every indicator, every quote-unquote system. But when I really took time to look at it, the market's truly an auction. And I know I'm going to ruffle a whole bunch of feathers, and people are going to say, no, it's not. And there's the man behind the curtain, and there's I don't subscribe to it. I trade every single day. I know exactly where we trade and how we trade. And statistical backtesting shows that there's no man behind the curtain. It's the market seeking institutional liquidity to match their orders to fill and make money. So one of the biggest misconceptions we see out there with liquidity is, like, every time you see the chart right here, every time you see a swing point, that's a buy or a sell, right? I've got a 15-minute chart up here on the NASDAQ last week. And a few things I want to address on here is where you see areas where markets take liquidity and sweeps. Let's go, for instance, down here. We took a London low, and we saw an immediate response here. But there's other areas where we took, for instance, we took a New York high right here, New York lunch high. We came back, small reaction, went right back up. What did we go to? We went to another point of liquidity here, 1800 candle. The liquidity sweep alone does not tell the story. What tells the story is what happens afterwards. And I'm going to kind of get into what the underpinning of, at least my perspective, of how liquidity works in the marketplace. You have institutions that are trading. If you've been trading for a while, you realize that small retailers, even small institutions, don't matter much in the marketplace. If you look at some of the level twos, Bloomberg's deep charts, Bookmap, you'll be able to see some orders executed in there. There's orders executed to the scale of 500 to 5,000 contracts, minis at a time. For instance, guys, if you're executing 1,000 minis, you're moving in the market $20,000 US per point. I'm not trading that many minis. What I am doing, though, is I'm following the flow of where these orders need to be filled. For instance, if an institution understands that the market is coming down, they have a predetermined ideation that below this point right here, they would like to participate and buy, or they would like to buy contracts. Now, if there was not a pool of buyers sitting down here ready to close positions, ready to take profit, if the institution was to come in and dump 1,000 contract order on here, you would immediately see a spike so huge it would move it hundreds of points. You have to have, because it is truly a supply and demand marketplace. And I read Oliver X, and I follow a lot of hedge fund traders, and I know a few of them, where there's this AI is going to come and find your orders. I do absolutely agree that AI has a huge part in finding an algorithmic delivery of price. Let me redact that. Not algorithmic delivery of price. Algorithmically determining where the highest probability of orders are sitting in certain swing points. And entering a price with more efficiency. But it still comes down to the fact that you have to have people here willing to sell their contracts in order for the institutions to participate and get on board and buy. It's basic supply and demand. If they need to buy 1,000 contracts or 10,000 contracts here and nobody's willing to sell, do you understand what that would do to price? When people say price is random, price is not random. They're matching buyers and sellers in the marketplace. If institutions know that they want to participate in the level of 28,550 and nobody is willing to sell their orders there, and they dump an order of 1,000 on the marketplace, you know what the supply and demand on the second level chart would look like? You would skyrocket our price. When we see price what's called unbutton or unpin and move aggressively and just downfall or scream straight upwards, is because you don't have matched sellers or buyers on the opposing side to stop price from moving. So we kind of dig deep into that. There's certain areas where price has orders that sit. London low, London high, session highs or lows, opening day 1,800 candle, true day open, session highs or lows. And these areas that we mark out in here, and it's very easy to see, we have New York low here, right here, New York lunch high. We came all the way through to the next day, and you see a huge price reflection here, but the price didn't immediately turn and go the other direction. showing that there was not enough interest in here. There was not enough sellers' interest in here, not enough orders for the people that want to sell this to match up to force the price down. What it did, it had to come all the way up to 1800 candle here to another session. So the point being is not every sweep determines that you buy or sell at that sweep. What happens is after the story. What happens after the sweep occurs? For instance, here in this case, you saw a New York lunch high that occurred on July 17th. We carried it all the way forward here to July 20th. 3 days later, we went and took this. Yes, we saw some reflected because there are absolutely people wanting to sell right here. Those orders occurred here, but it was not strong enough to move the price down. It came down, absorbed orders, and what did we do? Immediately came back up to the next session here. So it's not necessarily in your sessions that you're looking for liquidity sweeps. Every sweep, it's going to reverse and go the other direction. You have to look at what happens after. So again, saying like institutions need liquidity, they're paying attention to how many people are putting their orders on the books to be sold short. If an insufficient amount of orders are on the books to be sold short, if an institution wants to come in and buy 1,000, 3,000, 5,000 orders of minis, if they were to absolutely dump that on the marketplace, they would still skyrocket this. You don't have the matching orders. What you did have here, though, is where institutions found that there was a sufficient amount of people willing to sell their long positions to dump orders into the marketplace where they could reposition themselves and come down. Buyers are going to come back up and try to, they're going to try to come back up and retake this. Inability to retake this is easily graphically seen here in these candles. They're not going to be able to be successful, and they're going to continue. Even market makers, when I say market makers, institutions are market makers on a large scale with agreements with the exchanges to provide liquidity at all times. I want to clear that one up first and foremost. There's no folks behind curtains that make the market that sit there and play both sides. Market makers are nothing more than large institutions that have made contractual agreements with the exchanges to provide liquidity to the marketplace at all times, no matter what. That's why there are circuit breakers or lock limit downs in marketplaces to protect large institutions. So moving on here, why the kill zones matter. We trade primarily in Liquidity Cartel in certain times. Time does matter, and I read this continuously, and I have questions from students and other folks all the time, like, well, the market is tradable all the time. Sure, but not for me. I want to see high probable times where the institutions are participating heavily. The institutions participate heavily in this order: New York AM Open, London Open, and Asia Open. We see institutional participations post-lunch in the New York session. We see institutional participations in the last 10 to 30 minutes of the market on close, depending upon if we are in a rotational earnings season. We see institutions participate in the EU zones, particularly in the London kill zones from open in the first 90 minutes. And then lastly, we see institutions participate in the Asia markets, first 90 minutes. So those are the times where we see sweeps that are valid. I used a couple of them here. We see the New York lunch high here, where it was pretty much disregarded until it came up and took a significant point where you see the market reject significantly. And the market rejection was nothing more than institutions sitting here waiting for this sweep to occur, waiting for two things. Waiting for the longs to come up here and understand, I'm done with my position. I have hit my objective and I'm reached my profit taking. I'm putting this on the market for sale. Whether you can see it in deep charts, book map, level 2 Bloomberg, whatever, if you can visually see it, a lot of times they don't let you see that. They're not going to put their stops, and they're not going to put them in place. They're going to put them on demand, and they're going to sell them when they hit those orders. Putting them up here is like putting a giant neon sign saying, I have orders sit up here, come get me. That unfortunately went away many years ago. So we see this move down forcefully, and we see the market start to migrate where? To a New York PM low. Did it come through these liquidity points and push through them? Absolutely. These are swing points. Everyone says, oh, these are swing points. These are liquidity points. Yes, there was some semblance of liquidity here, but there was not institutional level buying that occurred to trigger this move right here. It's not the liquidity sweep that matters, it's what happens after. The sweep starts the story, guys. So to kind of wrap this up a little bit, how we look at the markets and Liquidity Cartel is, Is liquidity king? Yes. Does liquidity tell the story? Absolutely not. Does it start the story? Yes. I need to see an area where buyers and sellers are heavily transacting. Does that mean I get in a market? No. One thing that we've perfected, or we've done very well with, is identifying areas of liquidity that have high value, and whether it's through the use of certain times, i.e. kill zones, New York, London, Asia, kill zones, identification of volumetric movement, the first opening range of the New York AM session, 9:30 to 10 o'clock, and then the second hour from 10 to 11 o'clock. There are certain chronologic areas where we match time with volume that has high value areas of sweeps where institutions are getting involved and repositioning themselves. So what I like to say is the shift is the confirmation that something is happening. As you can see here, we hit areas, 1800 candle, we hit this, there is a shift occurring. I came back down here and swept New York PM low, there is a shift occurring. There's areas here, New York lunch high, there is a shift occurring. The London low that occurred way back here, there is a shift occurring. These areas inside where we have these swing points, no shift occurring. So identification of critical points of liquidity and what to look for when those areas are hit. Am I looking at these areas and they're taken? Yes. Do I have a very specific algorithm that I look for as far as specifics on how I decide whether or not this is going to be an area that I have high interest that I want to look at to trade? Yes. So, in saying that the shift is the confirmation, I'm looking for it to migrate value. I want to see, like in this instance here, where we took the 1800 candle, we forcibly moved 100 points in 15 minutes. This is showing that the institutions came in here, absorbed every bit of the buyers that were liquidating positions, went short, and took the market another 50 to 170 points down. Okay, so Liquidity Cartel, if you want to explore deeper in what we do, I'm making a series of videos on this. It's very much based upon the Wyckoff theory, market auction theory. I spent many years studying some of the really great traders, all the way back from Jesse Livermore to Mark Douglas to Richard Dennis and the Turtles. I'm not saying that this is for everybody. If you want to truly understand how market auction works, how liquidity works, and how you can use it effectively to enter and exit trades for high profitability, come check us out at Liquidity Cartel. Thanks a lot, guys. Have a great day.